Hello viewers, welcome to the presentation on the business policies of the finance function. What is a business policy? The business policies are basically the guiding factors for any organization to govern the actions. It guides the middle and top management in their decision process. Such policies are in place for all the functional areas starting from production, marketing, finance, HR, pricing, procurement, logistics, and so on. This presentation will discuss the policies with respect to the finance functions. Let us see the investment related policies. See, in an organization, the evaluation of the business opportunities is a very important issue handled by the finance department. So you always look into what is the IRR of the project, internal rate of return. This IRR should be more than the weighted average cost of the capital. So they may take a call whether they should take a project with the average return or a high return. So accordingly, you'll be able to select the project or drop the project for further study. Then the next issue comes that should you go for an asset light or asset heavy organization? Today there is more and more compulsion to go for asset light because the environment is becoming quite complex and unstable. It is very risky to commit a lot of your fixed assets. Sometimes it may create a lot of exit barrier to you. But sometimes the assets are also specialized in nature. You may not be able to go for an asset light. In that case, you have to go for only asset heavy. Then make or buy decisions. Today, many organizations are revolving around the core competency area. That is, they want to concentrate on those activities which is adding value to the core competency, and all other activities they want to basically outsource. So in that case, you need not have to commit your investment for those activities, and obviously your asset also become lighter. Over a period of time, as the organization function, the environment also keeps changing and certain businesses become a poor strategic fit. In such situation, only the finance department has to take a call when exactly you have to take a divestment or when exactly you have to exit from the particular SBU. Otherwise, that will be a drag on the organization. You would have seen recently Hindustan Lever has acquired Horlicks and other brands from GSK UK, basically a pharmaceutical company. So this pharmaceutical company thought that why should we concentrate on brands like Horlicks instead of concentrating on the core pharma area. Then the very interesting area is about the capital structure related. Because today in a capital structure is nothing but what is the mix of debt and equity for your project actually. So we have got a multiple options available as you see in the decision tree. You can go for debt or you can go for equity fund. Once you go for equity, you can raise the equity in the domestic market like through your public equity or private equity or venture capital or angel funds. All depends upon what is your project, what is the nature, is it a startup or regular project and all that. You can go for international equity by way of ADR or you can for GDR or you can go for masala bonds, etc. Suppose you want to concentrate more on debt fronts, you can go to the domestic source like you can go for term loan, commercial paper or your working capital loan or fixed deposits or unsecured loan like that you can go for. If it is going to be an international debt, you can think about FRN, floating rate notes, or you can go for Yankee bonds. So equity and debt each has got its own plus and minus. So you have to arrive at the optimum capital structure so that you will take the advantage of both debt and equity. If you take Bajaj Auto, traditionally it is highly equity oriented organization. They very rarely go for any debt raising and all that. Whereas if you take Reliance, it has started more as a largely equity driven organization. Of course, equity plus debt mixture. At some stage, it has become a more debt driven organization because they wanted to put up a world scale projects and all that. They want to put up faster. So they raised a lot of debts and put up the project. Now, thanks to your Geo platform, they're able to get a lot of equity funds. And you would have seen in the papers also recently, Reliance has almost become a debt free organization. So debt and equity mixture is a very important one that will be driven by your policies of your organization. Then investor related. See, an organization can have an option to go for a listed company or an unlisted company. The unlisted company has got its own obligations with the SEBI and other regulatory agencies, whereas unlisted companies will have certain advantages. So accordingly, depending upon the area you're operating and other aspects, you can take a call whether you should go for a listed company or an unlisted company. You take, for example, TCS is a listed company, Tata Sons the holding company, unlisted company. Once you go for a listed company, again you have a next option available. Should it be a widely held company or otherwise? If you take companies like MRF or Madras Cements, the shareholder base will be very small. Whereas if you take company like Reliance, they have a large equity base. So whenever you have a widely held company, you can utilize the stock market to raise funds. You would have seen recently Reliance has raised more than about 50,000 crores through rights issue for meeting some of their expansion projects and all that. Another next interesting point on which the policy has to be addressed is that what exactly is your dividend disbursement policy? That is, from my profit I am generating, how much of dividend I should distribute to my various shareholders. If you take IT companies, they're all quite liberal. In fact, every quarter they'll be dispersing dividend also. Whereas many traditional companies are all very conservative in dividend disbursement. Next, another important area is about the working capital. Working capital is again a lot of scope for you'll be adding to your cost. So you should have a clear-cut policies to handle the working capital related issues. So what are the various components you're going to see about? Let us take sub-assemblies. A typical automobile company will be getting a lot of sub-assemblies. They can always take a call, I'm going to have a just-in-time policy. So I need not stock any raw material. The supplier has to supply the components on the assembly line, and accordingly they will be having some terms and conditions of payment, etc. Similarly, suppose I'm going to have an aluminum casting unit. I can always think about putting the unit next to a aluminum smelter so that I need not have to melt the aluminum bars bought from a smelter. I can straight away use the molten aluminum. To that extent, I will be very cost competitive. Then level of stocks to hold. See, organization will normally having stocks in the form of raw material or work in progress or finished goods. All depends upon what is the type of raw material dealing, whether it is imported or locally available, or what type of work in progress you're talking about. Is it technically feasible to have work in progress? If it is going to have work in progress, how much you should have? Whether it's a seasonal raw material, it all depends upon you have to take a call. If you take a finished goods, for example, whether the finished goods stock, it should be in your custody, or it should be sold to your dealers or distributor, or the stock should lie with the dealers or distributors. So that's a call you have to take based on your policy guideline. Then policy on spares and consumables. Any organization have to keep good amount of spares and consumables, because to have a breakdown free operation, because you should have all the spares and consumables readily available. If the downtime of the organization is quite high, let us take, the downtime costs are all quite high, then you are expected to have a good number of spares and consumables so that most of the downtimes you will be able to address. In case the downtime costs are lower, you need to keep only some critical spares. Another important and interesting point to note down here is that non-moving critical spares. Many times what will happen, the critical spares are expected to be kept all the time, but only issue is that sometimes they will become non-moving in nature. So you have to take a call when exactly you have to dispose of the non-moving critical spare. Similar on the finished goods sales policy. Should I take advance from my customer and produce a product and sell, or should I be a cash and carry business, or should I give the product on credit basis? It all depends upon what is your competitive position level. If you are a very unique supplier, then you can definitely take advance or a cash. Or if you are in a very competitive environment, obviously you have to give credit to your customers. Then operations and cost related. Today, most of the organizations are all driven by a enterprise resource planning system, ERP system, that throws out lot of data about your various operations. So this data can be effectively utilized by the finance department for various cost control applications. So which particular product is producing more cost, which particular area is incurring cost, so you can focus on those things and go for cost control initiatives. Or even performance improvement, which SBU is doing well, which SBU is not doing well, and which individuals are doing well. All the performance improvements can be captured through the system. Fixed overhead cost. See, the fixed overhead cost itself says that these are all fixed in nature. But you can always explore, suppose you decide to outsource certain non-core activities, to that extent you will be able to reduce your fixed overhead cost. So you find out how you will be able to reduce the fixed overhead cost. So identify areas which are all non-core in nature, accordingly you work on that one. Then another interesting point is about the risk assessment of the operation. Any organization has got many risks in their operations. So you make a lot of assumptions in the whole thing. So you have a risk profile build up, you have a risk mapping. So there you focus on the high risk activities whose probability of occurrence is very low, and also the low or medium risk activities whose probability of occurrence is very high. So for both this category of activities, you better have the plan B ready. In case both the risks become a reality, you can immediately switch over to plan B so that your operation will not get stalled or will not get any surprises. And finally, what is your strategies in the deployment of surplus funds? Suppose my company is doing quite well, I am able to generate a lot of funds, surplus funds. So should I plow back the money into the business, or should I maintain cash for some emergency requirement, or should I put the cash into the short-term investment? So these options will be based on whatever the policy guidelines are available in place. So hope you all enjoyed this presentation. Hope you found it quite useful. You got some idea about what type of areas where the policy initiative should be in place for the various financial things. So thanks for your patient listening. Thank you once again.